Welcome back to the deep dive. Today we're doing a really focused technical analysis on just one stock. We're going to try and cut through all the market noise
Right.
and really just look at the patterns, the momentum, and the structure of what looks like a total price collapse. We're diving into Datavault AI Inc. The ticker is DVLT, and it has created this massive technical paradox.
And this whole deep dive, it's based on a really comprehensive technical report that covers about 62 days of trading.
Right.
And the conflict, the real paradox at the heart of it is this. How can all the technical indicators, almost all of them, confirm this powerful structural downtrend?
Yeah, a really bad one.
And yet the final recommendation is a high-risk buy. It just doesn't seem to add up at first glance.
Exactly. It makes no sense on the surface. So the current trading price, as of this report, is sitting at about 64.5 cents.
0.645 cents.
Oh. But to see the scale of the problem right away, you have to look at the historical context. The volume-weighted average price, the VWAP, for those same 62 days is all the way up at $1.94.
That is a huge gap.
That nearly $2 gap, that's the chasm we're trying to understand today.
And it is more than just a gap. It's a picture of where the market thought this company was worth over the last 2 months versus where it is today.
Okay.
And that difference, it really sets the stage for a truly high-risk situation. So, yeah, it's a fascinating study in technical conflict. We have to unpack what's confirming the collapse and what's suggesting maybe, just maybe, a temporary break.
Okay, so let's start where the damage is most obvious, the trend indicators. We need to establish just how heavy this bearish weight is on DVLT.
Right.
Because if you were only looking at the moving averages, you'd walk away immediately.
Oh, absolutely. The first thing any, serious technical trader looks at are the moving averages. They tell you the true direction of the ship, ignoring all the day-to-day noise.
So we're looking at both simple moving averages, the SMAs, and the exponential ones, the EMAs.
Exactly. And the findings are, well, they're completely unified.
When we compare that current price, the 0.645, to the SMAs, the price is trading below every single one of them.
Every single one.
And that includes the SMA 5, which is just the last week of trading, all the way out to the SMA 150, which is the long-term historical average.
And this is a really critical insight for you to grasp. The price hasn't just, dipped below a short-term level.
Right.
It has sliced through every single layer of historical support. Think of it like a building where the price has fallen not just through the first floor, but through the basement and right through the foundation.
And the EMAs, which are supposed to react faster to recent price changes, they just make it look worse.
They do. They reinforce that structural weakness even more dramatically. The fact that they're also confirming the SMAs tells us this downtrend is deeply entrenched. It's consistent. There is no historical level providing any kind of psychological floor here.
Okay, so this brings us back to that huge VWAP figure of $1.94. If the current price is 64 cents and the average buyer in the last 2 months paid almost $2, what does that actually mean?
That is the single most important factor behind that high-risk warning.
Okay.
That $1.94 VWAP creates what we call overhead supply. Just think about every single trader who bought DVLT, anywhere between, say, 70 cents and $1.94.
They're all losing money.
Every one of them. And if the price manages to tick up just a little bit, they aren't thinking, oh, great, time to buy more. They're thinking, I need to sell fast just to cut my losses.
So any little bounce immediately runs into this massive wall of people who are just desperate to get out close to where they got in.
Precisely. That VWAP isn't just a historical number. It's a huge psychological hurdle. It turns every price level above 64 cents into a potential ceiling.
Okay, so that's the structure. Let's talk about the speed. How fast is this thing falling? We look at velocity indicators for that, like rate of change and momentum.
And the numbers here, they basically confirm it's a panic. Momentum 10 is negative, which is no surprise. But the really alarming figure is the rate of change, the RC14. It is sitting at a devastating negative 58.63.
Wow, a 58% drop in 2 weeks. That's not a gentle slope. That's a free fall.
It is. It indicates a complete collapse of confidence. It's likely panic selling. When you see an ROC reading this extreme, it usually signals capitulation.
So traders are just throwing in the towel.
They believe the stock is functionally broken. It solidifies that strong downtrend, part of our final recommendation.
Now, here's where it gets interesting, where we get a little bit of friction. We just established the trend is destroyed, the velocity confirms a panic, but then we look at the MACD analysis. The histogram is negative, At 0.070, but that's a really small number.
That's a very sharp observation.
Uh,
If the ROC is screaming at NANA's 58%, why isn't the MACD a much larger negative number?
right. Doesn't that suggest that even if the price is crashing, the rate at which the averages are separating, maybe it's slowing down, like the downward force is losing a tiny bit of steam?
You have hit on the nuance that is absolutely key here.
Okay.
It shows that while the trend is still incredibly bearish, the sheer force in the last few days might be just a tiny bit less than it was before. It's a subtle hint.
A hint that the sellers might be getting tired.
Exactly. They may be tiring out. And that brings us perfectly to the core contradiction, the idea of indicator exhaustion.
Right. So if the structure is a mess and the trend is undeniably down, where does this potential buy signal even come from? It has to mean the market just went too far, too fast.
That's it. We pivot now from trend indicators to oscillators, which measure whether the selling has become so aggressive that it's just unsustainable in the short term. We're looking for exhaustion.
And the main indicator for that is the relative strength index, the RSI. The key numbers are 70 for overbought and 30 for oversold.
And our source material shows the RSI 14 for DVLT is at 26.61. That is a firm oversold signal.
So explain what that number, 26.61, really means for a short-term trader. What's the psychology behind being below 30?
Well, think of the market as a runner. The RSI at 26.61 is basically telling us that runner has sprinted a marathon without stopping.
Okay.
The selling pressure has just reached a point of short-term exhaustion. It's not a signal that things are turning around for good. It's more of a pause to catch your breath signal. The selling just can't continue at this speed forever without some kind of reaction.
It makes sense. I mean, eventually, everyone who wanted to panic sell has already sold.
And we don't just rely on one oscillator. We look for a confirmation. And that comes from the Stochastic Oscillator.
And the reading here is truly extreme. The Stoch K14 is at an incredibly low 4.52.
That is nearly pegged to zero. If the RSI tells us the runner is tired, the stochastic tells us the runner is face down in the dirt.
Wow.
This extremely low reading just powerfully confirms the oversold condition from the RSI. And the combination of these two exhaustion indicators is the core reason for that possible bounce prediction.
Okay, so to put this in context, let's bring in the Bollinger Bands. The report shows the price position is 6.85 low with a width of 1.19 high, which is just confusing data without context.
Right, let's simplify. Being at the low position just means the price is clinging right to the bottom boundary of its normal trading range.
Okay.
Prices rarely stay pinned to that lower Bollinger Band for long without some kind of reaction.
Oh.
So when you combine that physical position pushed hard against the floor with those extreme RSI and stochastic readings, the consensus is clear. A short-term reaction is statistically likely.
Okay, so now we get to the synthesis. We have two powerful opposing stories here. Story one is structural doom. Strong downtrend, all the averages agree. Huge overhead supply from that $1.94 VWAP and that insane ROC of negative 58%.
And story two is tactical opportunity. Immediate exhaustion, confirmed by both the RSI and stochastic.
So how does the technical report pull this all together into one final score?
The report tries to quantify it with a final technical score, bearish, rated at 4 out of 10.
4 out of 10 is low. It's definitely bearish, but it's not a 1 or a 2 out of 10. That's where the real lesson is. Why a 4 and not a 1?
Well, if the RSI and stochastic were neutral, say around 50, the report would be a firm 1 or 2. No question. It would just reflect the structural destruction.
Right.
The only reason that the score gets up to a 4 is because of that intense, immediate pressure from those two exhaustion indicators. The low score reflects the overall trend, but the fact it's not a 1 reflects the statistical weight of the oversold signals creating uncertainty.
The structure is broken, but the immediate action is stretched to its limit.
Got it. And that leads us directly to the paradox. Strong downtrend, but oversold. Possible bounce. High-risk buy.
That high-risk buy is specifically betting on that ambiguity, on the strength of that 4 out of 10 score.
Absolutely. The buy is purely tactical. It is not an investment recommendation. It's a short-term trade, a scalp, betting on a momentary reaction against the main trend.
So you're betting that the temporary force of exhaustion is stronger than the momentum that's been driving this stock into the ground.
For a very short period of time, yes. That's the bet.
Okay, so let's talk practicals. What makes this high risk for someone listening? If they're betting on a bounce, what are their targets and what is the actual risk?
The targets would have to be very, very tight. A short-term bounce might realistically aim for the first layer of resistance.
Like the first moving average.
Exactly. Maybe the SMA 5 at around 79 cents. That's a quick 20-25% gain from the current price. excellent for a scalp. But the risk, the
Yeah.
risk is immense.
Because if that bounce never comes,
If it doesn't materialize, the main structural trend, the one confirmed by everything else, will just take over again. The price will simply continue to make new lows, and it will blow right through any stop loss you have. The downside, given the damage in that huge overhead supply, is potentially unlimited.
this analysis really shows you can't just look at the final recommendation in these reports. You have to understand the internal battle that produced it. The long-term picture is terrifying.
It is. But the immediate, short-term picture offers a calculated, albeit very small, window of opportunity.
That is the core lesson here, I think. Technical analysis isn't always one clear signal. It's an exercise in balancing powerful, conflicting forces.
It's a classic technical tug-of-war. One side has already won the war, but the other side is trying to win one small momentary battle.
Right.
And that tension is what defines the risk. We know the stock is far below its historical average, that $1.94 price represents a huge weight of sellers waiting to get out. We also know the collapse was swift and brutal, confirmed by that negative 58 ROC.
So the final provocative thought to leave you with is this. When a stock has fallen this far, this fast, what's the real probability that the structural downtrend just ignores those oversold signals and keeps going? You're placing your bet not on the company, but purely on whether the selling can stop for just long enough to catch its breath. And that is the high-risk, high-reward question at the heart of this entire analysis.